Hello, my name is Peter Alex, and today I'll be presenting on the Delio Foods Incorporated currency exchange problem, which is Project 3 in our course. Here's the agenda for today. First, we will discuss the background information regarding Project 3. Then we'll go over the issues that need to be addressed. Next, we'll discuss the solution. Then we'll talk about the pros of the solution, the cons of the solution, and a conclusion, what I think the customer should do, what I would recommend to the CFO. Let's take a second to discuss the background information. In this case, we are presented with Delio Food Company. Delio is a fast food company that purchases vitamins for its products from a supplier abroad. Delio recognizes that currency fluctuations impact its financial statements, and therefore, they are looking for a financial hedging instrument that would reduce the company's risk and smooth earnings. The text does not specify which country Delio's supplier is located in. It rather gives us a list of countries and currencies to choose from. For the purposes of this project, I chose Canada. Here's the graph that shows the relationship between the two currencies, the US dollar and the Canadian dollar. The dates listed on the graph represent the first of every month, starting with April 1st, 2017 and ending with April 1st, 2018. As you can see, the red trend line on the graph indicates that within this 1 year period, it increasingly took slightly more US cents to equal 1 Canadian dollar. In our case, this means that over this 1 year period, it cost Delio slightly more money to purchase their vitamins solely because of the currency exchange rate. This would have absolutely impacted their financial statements. Using this, we will infer that this trend line will continue in the future, and I will make suggestions based on an increasing Canadian dollar strength. The issue that needs to be addressed and solved is how does the company reduce their risk associated with a fluctuating currency? Solving this problem will allow company executives to focus their limited time and efforts on more pressing issues within their business. The solution to this issue is for the company to engage at a financial institution with a forwards contract. With a forwards contract, the company and a financial institution would agree to trade currencies in the future at set and agreed upon prices. By entering in these types of contracts, the company will have reduced its risk exposure related to currency rates. Positives of a solution. Obviously, entering into the contract would somewhat solve the original issue. Additionally, when creating the contract, the company would be able to fully customize it to fit their predicted future currency needs, meaning they would be able to determine the exact amount of the currency trade and specifically when they wanted the trade to occur. Lastly, there are usually no upfront costs associated with forward contracts. Costs would be paid when the transaction occurs. This could be really helpful to startups or any business with a struggling cash flow. Despite the positives, there are three drawbacks associated with the contract. First, once entered into the contract, it is probably not voidable. This would become an issue when the agreed upon price is higher than the market price. In this situation, the company would pay more for the vitamins than it would if it never entered the contract. Secondly, these type of contracts are not traded on a centralized exchange, which means that the terms between different contracts may vary. Also, this may also mean that under certain economic conditions, these contracts may not be offered by financial institutions. Lastly, if the contracts result in a gain, there may be tax implications. In conclusion, entering into a contract of this sort is a great way to reduce the risk associated with the currency rate fluctuations. It will also allow the company to more accurately estimate their year-end earnings and will allow the company executives to focus on other more pressing issues. However, because of the binding nature of this contract, executives should probably be confident in the direction that they think exchange rates will move. Thank you.